Let's talk about something that often surprises first-time private equity investors. And that is why early returns can look so disappointing, even in a strong fund. Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm here in South Texas. At Avion Wealth, we work with business owners, executives, and families who are navigating complex financial transactions, and private equity often plays a role in those conversations. So let's get back to this early dip in returns. It's called the J-curve effect, and it's named for the shape you typically see. That is, early on, returns dip, and then they can rise quite sharply over time. So what causes that dip? It really all comes down to the timing and structure of private equity. Private equity tends to front-load their fees, and expenses hit almost immediately. That includes management fees, setup costs, all are hitting before the underlying investments have had a chance to grow. Moreover, capital is often deployed gradually as opportunities arise. So in those early years, you're seeing costs first, but where are the returns? Well, those can often take several years to materialize. Now, this isn't necessarily a red flag. It's just how the math works in private equity. The key is understanding the timeline and having the right expectations going in. By year 5 or 6, the picture can look very different. Companies now have had time to grow, exits have started happening, and that curve has long since bent upwards, sometimes quite significantly. This sequence, costs hitting before returns show up, isn't something that most retail investors are used to. So when they see negative performance early on, they often start to second guess their investment and bail out, just as the J-curve is about to turn upwards. Now, if you're evaluating private equity or already in a fund, just keep the J-curve in mind. Remember that early performance doesn't always tell the whole story. These are very much long-term investments. Now, private equity just isn't for everyone. Not every private equity opportunity makes sense. The reality is, unfortunately, the lower quality deals often get sold the hardest. And if you think about it, that really makes sense. It's also why it's so important to evaluate the structure, the strategy, and the people behind the fund before thinking about committing capital. And if you'd like a second opinion on how a specific private equity opportunity fits into your broader strategy, reach out. We'll be very happy to provide a complimentary second opinion of the opportunity. No pressure, just insight. We wish you the best of investment success.